The best way to improve your investment's risk-return profile is to diversify into alternative assets and strategies. Hi, this is a new channel dedicated to alternative investing, and my name is Mike. On this channel, we will look at investments and trading alternatives like derivatives, hedge funds, quant strategies, and emerging markets. Emerging markets like the Chinese stock market, futures market, options, and other derivatives. Of all the emerging markets, none is bigger than the capital market in China. In the following series of videos, we will delve deep into investing in China. We will examine the Chinese stock market, the Chinese commodities market, as well as all the related futures, options, and convertibles. Along the way, we will also present suitable strategies for both trading and investing in these markets and answer any questions that you guys may have. So why should we invest in China? Let's look at some data and trends. China has the largest population in the world with 1.4 billion people, while the US comes in third with 331 million. In terms of GDP, the US has been the world's leader for years, but China has been catching up quickly in the recent decades and is now the second largest economy in the world. This chart shows the trend of China's GDP as a fraction of the US GDP has grown from 9% in 1995 to the current level of nearly 67%. Now, looking at the ratio of total market capitalization to GDP, currently this ratio for the US is 128%, while it is only 35% for China. Therefore, taken all together, these data show that China's equity market has room to grow or it is undervalued. There is enormous potential in the Chinese capital market. I can blast a lot more data and statistics to you about China, but we won't spend any more time on why one should invest in China. Since you already found this channel and you have watched the video until now, you very likely already know why you want to invest in China, or at least you know enough and are curious enough to find out more. So let's dive right into it. China has two major stock exchanges. They are the Shanghai Stock Exchange and the Shenzhen Stock Exchange. The Shanghai Stock Exchange is located in the city of Shanghai on the eastern seaboard of China. The city is a financial center of China. The Shanghai Stock Exchange started its formal operations in December 1990. Currently, there are over 1,600 companies listed on the exchange, and the total market capitalization traded on the exchange is $4.7 trillion. As a comparison, total market capitalization for New York Stock Exchange is about 23 trillion. The average PE ratio for stocks traded on Shanghai Stock Exchange is 13.6. The Shenzhen Stock Exchange is located in the southern coastal city of Shenzhen, just across the border from Hong Kong. It's a hub for financial and high-tech companies. The Shenzhen Stock Exchange was established in 1986. Currently, over 2,200 companies are listed on the exchange, with a total market capitalization of $311 billion. The average PE ratio for stocks traded on the exchange is 25. In addition to stocks, both stock exchanges also trade other listed securities. There are treasury, corporate, and convertible bonds, closed-end funds, LOF, and ETFs. Most recently, listed index-based ETF options have just started trading on both exchanges. We will look more into these securities in the upcoming episodes on the channel, so please hit that notify bell to be alerted. Investors and traders usually gauge a market's performance using an index like the Dow Jones or the S&P 500 index. The most quoted index in the media for the Chinese stock market is the Shanghai Stock Exchange Composite Index, or the SSE Index. It is the index of all the stocks traded on the exchange. The SSE 50 Index represents the top 50 companies by float-adjusted market capitalization and is the blue-chip index of China. The CSI 300 Index is a market cap-weighted index and its constituents are the largest 300 companies listed on the Shanghai and Shenzhen exchanges. Lastly, There's a CSI 500 index, which consists of the largest remaining 500 stocks that are not in the CSI 300 index. The index reflects the overall performance of small and mid-cap stocks. Of the four major indices mentioned above, the Shanghai Stock Exchange 50, the CSI 300, and the CSI 500 indices all have their corresponding features, which make trading and hedging with these indices possible. Now let's go over some of the more unique features of the Chinese stock market and exchanges. These peculiarities apply to both exchanges with very minor differences. First of all, the trading hours are rather unique. Each trading day, on a day that the exchanges are open, is divided into the morning session and the afternoon session. Trading starts at 9:30 a.m. Beijing time, which is 12 hours ahead of the U.S. Eastern Daylight Savings Time. The morning session ends at 11:30 a.m. local time. The afternoon session begins at 1 p.m. ends trading at 3 p.m. Therefore, the total actual trading time in any given day is only 4 hours. Second, the trading calendar, or the days that the stock exchange open for trading each year, is drastically different than that of the rest of the world. Chinese holidays are longer than that of the US. Most noticeably, the Chinese New Year and the Chinese National Day are big holidays. The holidays can be 7 to 10 days long for each celebration. Therefore, in total, there are about 24 days in holidays in China. Together with weekends, the actual trading days in any given calendar year is about 236 days, depending if certain holidays fall on the weekends or not, comparing to the traditional 252 days used in the US for calculations and trading references. Third, unlike Western markets, Chinese share prices display red when the share price has gone up and display green when the share price has gone down. This is more in line with Asian culture, where red is traditionally a lucky color. There are many more unique features regarding investing and trading in the Chinese markets that we will explore in future episodes. After this brief overview of the Chinese stock market, the key question is, how does an investor or trader get access to the Chinese markets? There are actually a few ways that an investor outside of China can get access to the Chinese stock market. For institutions, there are the QFII and RQFII channels. QFII stands for Qualified Foreign Institution Investors. As the name implies, is an official channel applicable to institutions only, and requirements are relatively high. For example, one requirement for asset managers is to have more than $500 million under management for 2 years or more. If anyone is interested in finding out more, this is an official link, and this will also be available in the show notes below. For individual investors and traders, there is a Hong Kong Stock Connect for both the Shenzhen and Shanghai Stock Exchanges. This cross-border investment channel allows investors and traders in each market to trade the shares of the other market using their local brokers and clearinghouses. Since the Hong Kong market is open to any investor, this effectively paved the way for foreign investors to transact Chinese stocks. However, the access is not to all the stocks in the Chinese market, but the list has grown steadily over time. Using the channel, currently there are 580 stocks and 708 stocks available for trading on Shanghai and Shenzhen respectively. A well-known online broker, Interactive Brokers, allow its customers to use this exact channel. The details can be found on Interactive Brokers' website. There is another way for non-Chinese investors to get access to the Chinese markets, which is to open an account with a local broker in China. Of course, this means you, the investor, have to travel to China and open one yourself. There are some extra requirements for non-Chinese nationals to do this, but this is definitely possible. This is how I have been and still am trading Chinese securities. We certainly can get into the details of the process in a future video. After this brief overview of the Chinese markets, we can delve deeper into many of the topics that we touched on today in future episodes on this channel. Please let me know in the comments below if you guys want to dive directly into more details on Chinese markets like futures and options, or we can look into strategies on how to invest in China to maximize return while reducing risks. Hope to see you in a future video. Be safe and be profitable.